Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to talk to you about what I will call international mismatches that will save you a bunch of money. And it comes from a conversation I was having with a client today. I was doing a call with somebody, and it's a common piece of confusion that I'm hopefully going to clear up for you guys. It's something that I hear a lot from many people that I talk to, etc. And yeah, we're going to clear it up. It is concerning the rules and application of rules and kind of a misbelief about where they apply and where they don't apply. And if you understand that they apply differently in two different places, I'm going to give you a bunch of examples of this. This can give you tons of advantages, okay? So let's dive into that. Before we do, if you haven't already, please smash the subscribe button, nail the notification bell. Really appreciate you subscribing. Make sure you don't miss out on any of our videos, trying to produce great content for you every single day. And if you would like help with international structuring, either for your business or for yourself personally, figuring out what is the best strategy for you or implementing it, please reach out to me. You can book a call, calendly.com/Michael Rosmer. There's a link in the description below, or you can send messages through our websites, offshorecitizen.net, offshorecapitalist.com. Okay, so I'm going to use a common example here, which is, well, let's use one that's kind of like, it won't apply to everybody, but I'm going to mention it then in a bunch of other scenarios that probably will apply to you, okay? So this is the subject of residency, okay? Residency versus registration. Now, if you form a company in one country, it's very likely that that is not necessarily what will determine the place of residency for that company. The residency of a company is often determined by where it's managed and controlled, not where it's registered, okay? And so great, you know, that's the way that it goes. However, if you look at payment processing rules are always just about where it's registered, not where it's resident, okay? Why is this important? This is important because you could be resident in a jurisdiction with low tax, but you could be registered in a different jurisdiction which has low payment processing rates. And you can mix and match these two things. And the ability to mix and match different rules by understanding that you don't have to apply the rules over here the same way you have to apply the rules over here makes a big difference. Okay, I'll give you like kind of a parallel for this. You could leave a country on one passport and enter another country on a different passport, okay? And in that gap between these two places, there's an advantage that can sometimes be pulled out, all right? Let's look at an example of this from tax rules, and I'm going to use the balance between Canada and UK, all right? So in UK, you get the non-dom program, okay? So it's great, non-dom taxes, whereby if you basically declare that your domicile is not UK, then you can qualify for the remittance basis of taxation, which you can't do if you have, if you are domiciled there, right? Now, what you might say is, let's say you were coming from Canada, and if you read the tax treaty, it will refer to, you know, resident by nature of their place of domicile, right? Or other criteria, right? There's a variety of different things, residency, domicile, blah, blah, blah. And so when I first was learning about this years ago, the question that I had, and I went to the person who was mentoring me and discussed this with them, was, hey, listen, hang on, if I'm claiming that I'm not domiciled in UK, then aren't I saying that I'm domiciled in Canada and therefore taxable in Canada, so it doesn't really benefit me in UK? And the answer is no, that's not true, because Canada doesn't even look at domicile. They don't even have a concept of domicile. They're paying attention to residency. Domicile is a UK concept. And these things don't have to match each other, okay? Very, very important. So I see this quite a bit where somebody will come to me and they're talking about like, hey, like, well, where's my tax residency gonna be? My tax residency and my actual residency and things like this. And it's like, hang on a second. Tax residency by whose standards, right? Like, who is asking you for your tax residency? Where is this idea coming from, okay? Sometimes it's the bank asking you. Well, the reality is that banks actually aren't in the business of determining what your tax residency is. So all a bank is really asking is, hey, where can you show me that you have a tax ID number and an address? That's really what the bank is asking, because what does the bank care about? The bank cares about filling out their piece of paper and checking off their boxes so that they can tell the authorities, hey, we did our due diligence and followed CRS rules, right? That's what the bank cares about. That's very different than what your country cares about. Your country might care about, hey, listen, are you actually paying taxes somewhere? And so these things don't have to match, right? There's, potentially consequences of declaring something to these guys, right? And there's consequences of declaring something to these guys, but these could potentially be different, right? I'll give you another example. Let's say that you are going from, let's say you're living in and connected to multiple different countries, right? And you're like, okay, perfect. I'm gonna go and I come from this country over here. Now, for the purposes of where I'm talking about banking, this is a better country to go to, right? Like, banks are gonna be much more open to me if I say, let's just pick a random one. Let's say somewhere in Asia, right? Let's say that you came from, I don't know, Thailand, and you went and you moved to somewhere in Europe, okay? And you wanted to then do some banking in Singapore, right? Well, if you tell Singapore, hey, listen, I'm in Europe, you're likely gonna have problems with banking. If you tell them, hey, I'm from Thailand, you're gonna have an easy time banking. Now, the reality is you're from both, right? And you're in a position, potentially, where you can mix and match what is gonna serve you best. And so yeah, this just, it doesn't have to be the same. When you're talking about this tax residency, right? Sometimes you don't need another tax residency. So some people will come to me and they're like, hey, well, but where's my tax residency gonna be? It's like, it doesn't matter. What matters is that you're not tax resident in your home country. And so the question is, what is the criteria that makes you not tax resident over here? That might be, hey, listen, I have a permanent home in this place, and I'm in a situation where I have a residency permit there, and I meet the standards of a tax treaty between these two guys. Maybe that's the case, right? But does that mean that I need to be able to get a tax residency certificate here? Does that mean that, hey, listen, I need to spend 183 days in order to qualify? Not necessarily. Sometimes maybe yes, right? Certainly not saying that, hey, you have to be in this, this is going to be the way it is all the time. It's a case-by-case basis. But be aware that sometimes what people are doing is they're like putting constraints on themselves. Maybe they've read an article online, or they've watched a YouTube video, or something like that. They've heard something from a friend. And so they get ideas where they start to put constraints. And when you start artificially imposing constraints on yourself, look, you've already got enough constraints imposed by governments and banks and payment processors and all these different groups. You don't need to apply more. So it's useful to pay attention to how much can I strip away? How much is really necessary? I'll give you a very significant example, and I'll end with this one. When Apple set up their corporate structure, I think it was 1980, okay? They set up their international structure where they were kind of one of the early pioneers of the double Irish with the Dutch sandwich strategy. Well, that's what it became called, right? And so they had these companies in Ireland. Now, I'll talk to people all the time, or it used to be more common in the past, but people who know nothing about tax planning, they go, oh, if I make a lot of money, I'm gonna set up in Ireland. I'm like, you don't know what you're talking about. It has nothing at all to do with setting up in Ireland. If you set up in Ireland, you're not going to get what Apple got. That's not what it was. What happened there was that the rules in the US and the rules in Ireland were fundamentally different from each other, specifically related to corporate residency. And so what would happen was the US said, hey, listen, a company is tax resident where it's formed. Ireland said a company is tax resident where it's managed. And countries don't necessarily need you to be tax resident somewhere else. What they care about is that you're not tax resident in that country, okay? You have to understand, I was having a discussion with another client about this, about some tax law, and it was this interesting conversation because they'd been given some advice that was really bad because it took a very one country-centric view. And the piece of advice was basically, hey, listen, if you're not taxable in this country, you have to pay taxes somewhere. No, you don't. It doesn't work that way. If you're not tax resident in a country, that's it. It's the end of the story. It's not it's like, oh, hey, well, we're going to tax everybody who's not tax resident in our country. They can't do that. That's not the way that it works. Nobody is the global tax man. You are tax resident in a country, or you're not tax resident in a country. You're not tax resident or resident somewhere else. That's not what happens. And unless it's very specific under that country's rules where a citizen is required to be in that case. So we'll go back to the example with Apple. What happened with Apple? Apple, if they were talking to Ireland, they said, hey, we're not managed and controlled from Ireland, so we're not tax resident. They didn't say, hey, we're tax resident in the US, where we're managed and controlled. That didn't say that. Then when they talked to the US, they said, hey, we don't meet your standards of tax residency. We're registered in Ireland. And they didn't say we're tax resident in Ireland. They just said we're not tax resident in the US. They declared no tax residency for it was like 30 some years, right? A long time, and paid no tax as a result. So this is an example of just where you can have these mismatches that you just need to pay attention to the locality that you're like. Don't worry about if this person is asking you this, you can answer them related to what they're asking for, and you can go in and answer these people here based on what they're asking for, and these don't have to align. These don't have to match because they only have this small context that they're dealing with. So anyway, I hope that helps. It's kind of like a crazy concept, but it's useful when you're thinking about how to optimize international structuring and when you're figuring out where to move and what rules are going to apply to you and things like this. Try and reduce the number of rules that are applying to you, not increase them artificially, because the world is not going to be increasing them for you. So you're just applying a constraint on yourself that you don't need to. So I hope that makes sense. If you have questions, put it in the comments below. If you have not already, again, please hit the subscribe button. If you like the video, give it a thumbs up, share it with your friends. If you don't like it, please tell me why. I would love the feedback and really appreciate you guys subscribing and watching the videos. I'm going to look forward to seeing you on the next video.